Hello and welcome to a very special episode of the Vancouver Life Real Estate Podcast. Today, we are thrilled to welcome the Chief Economist at BMO Financial Group, Mr. Doug Porter, to the show. He has over 30 years of experience analyzing global economies, financial markets. Doug is a leading voice in the world of economics. He oversees macroeconomic and financial market forecasts and guides a team that has earned numerous accolades, including #1 rankings for top US forecaster and top Canadian inflation forecaster in 2023. We're honored to have Doug here to share his insights on this week's interest rate cut, the economy, financial markets, potential tariffs, and what we can expect in the months ahead. Doug, welcome to the show.
Thanks for having me, Dan. Pleasure to be here.
Perfect. Let's dive right in here because we're just a few short hours since the Bank of Canada announced a 25 basis point rate cut. Now, this was widely predicted to take place, and it does mark the 6th straight cut in a row. Doug, what are your sort of main takeaways from today's rate cut, and what were the main factors that led to the governor's decision?
Yeah, well, as you indicated, it was really no surprise that they cut again today. The market was almost entirely looking for that. What was a little bit of a surprise was on the technical side. They've actually officially ended so-called quantitative tightening, so they are no longer reducing the size of their balance sheet. We knew they were going to do that at some point this year. It actually came a little bit earlier than we expected. And it seems like that's just a technical move. It doesn't really have a lot of policy implications. I think it's a little bit of an important signal because, that almost seemed to be going in the opposite direction of their interest rate cuts. The fact that, at the same time they were engaged in the so-called quantitative tightening. Well, now they've decided to stop that. And, the next move they make will be just pure easing. Like before, when they were bringing down interest rates, they would tell you they were getting out of so-called restrictive territory. So after a period of really high interest rates, they were bringing them back down to a more normal range. Well, now if they were to reduce interest rates any further, that would be clear on easing. And I think that's more consistent with what they're doing with the balance sheet. So even though it seems like a little bit of a technical measure, I thought it was a bit of an important signal as well. But the bigger story here was really the whole conversation about tariffs, and I'm sure we're going to get more into it. That's really what the market was looking for. Like, how are they seeing this? How are they going to react to it? And they still kept their cards pretty close to their vest. I mean, Macklem told us a lot, but they're no longer giving us any forward guidance in terms of where they see rates going next. So they didn't even talk about the possibility of further rate cuts. I think there will be further rate cuts, but they didn't even talk about that. And, while they laid out a scenario of, what it might mean for the economy if we're hit with tariffs, they were pretty vague in terms of how they would respond on the interest rate front.
It's pretty interesting, Doug. Thank you. Doug, the feds have also decided to cut immigration levels, and some pundits have argued this year that one of the only measures that was really propping up our economy was this constant high degree of immigration taking place at the federal level. And now with recent cuts, both to this year and going forward, what kind of impact do you think that'll have on the broader economy and subsequently on the Canadian housing market, both in the short versus the long run?
So I've got a very particular view on this front. I actually do not think the immigration cuts are that big of a deal for the short-term growth outlook, and I think this runs counter to a lot of other economists. The Bank of Canada did somewhat shave their view for growth for this year and next year, and they put down some of that to the immigration cuts. But we're talking tenths of a decimal place, like really small moves on that front. And I would assert that you could be somewhat reducing the growth outlook just because of the uncertainty around trade. Even if we're not hit with tariffs, we've got a little bit more of an uncertain trade backdrop. I think that's enough to believe that the growth outlook has been dimmed a bit. I don't believe there is that close of a relationship between population growth and economic growth in the short term. In the long term, sure. Like over the next 5 to 10 years, yes, population growth is an important building block of overall economic growth. But if population growth was such an economic driver, we would have had an economic boom in the last 2 years. Because we had population growth like we haven't seen in more than 50 years. We had, an average more than 3% in the last 2 years. And yet the economy only grew by a little bit more than 1%. I really push back on this view that, we would have been in a recession, were it not for population growth. I see it differently. We probably wouldn't have had to have rates go as high had we had much slower population growth, because I think that did fuel a lot of the housing and rent inflation we saw. And, it would have meant that the Bank of Canada didn't have to raise rates that high. So to me, it's really not that clear that that population boom was somehow supporting the overall economy. I really do take a different view. Um, longer term, yeah, I mean, one of the big supports for the housing market, no question, was that strong population growth. So we've been through 2 years where rates were high and population growth was really high, and they more or less offset each other. But I would say rates tended to dominate for the housing market. The next 2 years, complete reverse on both fronts. We're looking at much weaker population growth, but much lower interest rates, more or less offsetting. But I think rates will tend to dominate. So, yeah, we've had that population growth support knocked away from the housing market, but we're looking at a much friendlier rate environment. And I think that wins the day ultimately. The last point I would make, and this is an important topic, by the way, last point I would make here is that I think this is just a 2-year phase where they're looking at much lower population growth. It's basically a correction to the excess of the past 2 years. When we get out into 27, 28, I think we're going to be back to quote normal levels of immigration and population growth. And it doesn't matter who's in power in Ottawa. There might be a subtle difference between the Liberals and the Conservatives on immigration, but I don't think from a broader standpoint, there'll be that much to separate the two. And I think we're going to be back at population growth of about 1 to 1.5% after a 2-year hiatus.
So, as you can imagine right now, it's a very difficult time for borrowers to try to decide on what to do, right? And, the fact is we get new info every day, and it seems to be, a big topic of conversation. A lot of borrowers are trying to choose between obviously variable and fixed. And one of the strategies is to take a variable, ride it all the way down until, the end of the year, and then convert it to a fixed. Where do you see fixed rates ending up by the end of 2025? And do you expect variable rates to become more competitive in that period of time as well?
The short answer to your second question is yes. On the fixed rate, so a very interesting thing has happened globally in the last 3 or 4 months. Even as the Fed has been cutting interest rates, they actually did not move today, but they have cut rates by a percentage points. We've actually seen long-term yields around the world go up since the Fed began cutting interest rates. Initially, Canada wasn't caught up in that, but even in Canada, we've seen the long-term rates go up. And ultimately, that's what really has a big bearing on the fixed rates. Our official view is we think that those bond yields will creep down a bit over the next year, but we don't see a whole lot of room for the fixed rates to come down that much. There's a little bit of headroom for them to drop, but I think they're going to be a bit sticky here. So I wouldn't look for a whole lot of decline in fixed rates through the rest of this year. And of course, this brings us back to the perennial question: well, fixed versus floating. It's a close call. The market's efficient. A lot of it's personal preference. Your own personal situation. I would tend to favor floating because I think there is the possibility that we could go through a really rough economic experience, especially with tariffs facing us down over the next little while. And there is the possibility that the bank might have to cut aggressively, like much more than what's priced in the market. So I think there is the outside chance that rates could really tumble over the next year. Whereas I don't see that much risk of rates backing up or surprising on the high side for the short term. So I think I would tend to favor variable, but I would stress it really depends on the individual's risk tolerance.
It's almost getting harder to predict than ever. It feels like.
Indeed.
And also, I mean, a lot of the focus right now, of course, is on tariffs. But, tariffs aside, there is a new president in place either way, right? And he's going to be there for likely the next 4 years. So with that decided, obviously Canada still has some uncertainty within our governments. But from what we can tell, what's going to happen in the landscape here? What potential economic threats exist that you're keeping a close eye on, both domestically and internationally?
Yeah, and it's interesting. I heard a good quote this week that here in Canada, the number one topic or economic topic of conversation is the possibility of U.S. tariffs, and meanwhile in the U.S. Tariffs on Mexico and Canada don't even rate in the top 20 of the economic discourse there. I mean, it's it's a thing, but it's not really where the focus is. There are a lot of other economic issues we're dealing with the new president. I talked a little bit about the backup in long-term interest rates we've seen since Mr. Trump was elected, and some of that is, on some lingering inflation concern in the U.S. The U.S. economy has tended to be a lot more resilient and strong than what many expected. There's also a lot of concern over the U.S. budget deficit. their budget deficit right now is $2 trillion. It's more than 6% of their economy. That's much, much bigger as a share of the economy than Canada's budget deficit is. Their debt to GDP, their government debt to GDP is now 100%. We haven't seen that since the end of World War II. I mean, they've got a really serious fiscal challenge on their hands. But I guess if you were to ask me, like, what's keeping me awake at night internationally, besides the tariffs, it would be just this underlying tension between the U.S. and China in particular, but the broader issue of just the U.S. versus Russia, China, Iran, North Korea. The geopolitical concerns are rumbling away, and Mr. Trump is a different kettle of fish from Biden for sure. I think he certainly injects a real element of uncertainty into the geopolitical side, let alone the economic side. And those are the kind of concerns I have. It's not so much sort of the traditional things like inflation or growth, or it's more some of the geopolitical risks that are out there that have been staring us in the face for a while, but I think are actually going to be an even bigger deal under Mr. Trump, and with some of the different and uncertain policy he brings to the table.
Doug, you bring up some interesting points there, especially the fact that, excuse me, the trade tariffs in Canada are on every news line, and you go down south and you don't see it anywhere. And I think that's largely a reflection of, a $500 billion trade between the countries here represents what, 21% of our GDP, but down there it's maybe 1%, right? So my sort of fear around that is that they could continue to step up this trade conflict if they choose to do. And it would be harder for us, certainly in the near term, to deal with, which is going to add complexity to everything we're talking about. And I'm now going to give you a question that is going to be sort of difficult to answer and maybe more on the opinion side of things. But seeing as Canada is also going through a huge political shift here, if you were going to advise the next prime minister on where we as a nation should be focusing our energy when it comes to housing, or even more just the economy as a whole, what sectors, what policies should we really be focusing on, especially to address the things like affordability that we've had in our country over the last few years? It seems like every politician wants to deal with affordability, but none seem to have the answer or want to face the fact that there is no short-term solution to this, that this is a long-term solution. Can you maybe, provide some insight there? And one last piece to that, Canadians and some of the people that we are dealing with in our market here are trying to decide between, do they go down south to Seattle, and do they live a very similar life that they would live here in Vancouver with improved levels of affordability, lower housing costs, and you're only 2 hours away from maybe your family, versus staying in Canada and being productive and contributing to the overall economy? I'd love to hear your thoughts on it.
Yeah, well, there's a lot to handle there, but I guess on the affordability issue, so my opinion in the last few years has been pretty consistent that the number one reason why affordability has deteriorated so much is we really did let the population grow faster than what the housing market could handle. I know most of the discourse in the last few years has been on the other side, how the supply has let us down and we haven't had enough supply. All I would do is point back to it was just 10 years ago that everybody in the world thought that we were overbuilding. Bloomberg had this running thing about showing how many condos were going up in Toronto and Vancouver, and how this was simply unsustainable, and we were building way too much. And suddenly the pendulum swung exactly the other way. And what happened? Well, we've had really strong population growth over the last 10 years, and just fiery hot in the last 2 to 3 years. We let in 3 million people in 3 years. Guess what? The housing market could not handle that. That is the number one reason why we are looking at such an affordability issue. Could we have done more on the supply side? Absolutely. I'm not. Look, I'm in favor of a lot of the supply side issues that people have talked about. I'm all for the federal government helping out the provincial government. BC is definitely one of the leaders on that front. Absolutely, we need more supply, but it was a demand and a supply story, and I actually think demand was the bigger deal. Supply is like a glacier that can only move so quickly over time. As I always like to say, there's basically 16 million dwellings in this country, and it grows by about 250,000 per year, and that is a calculus you cannot change no matter how much you throw at it. the industry can only build so many units per year because of constraints on labor and serviceable land. You just can't change that equation quickly. Demand you can turn on and off like a light switch between interest rates and immigration policy, and we way overcooked the goose in the last 3 to 4 years. And that's how I think we ended up in this affordability mess. I'm actually getting a little bit more encouraged on the affordability side between the steady decline we're seeing in interest rates and the much slower population growth we're looking at over the next couple of years. And we're seeing in rents in a lot of cities, rents are actually, big cities at least, rents are starting to back off now from admittingly from atrociously high levels, but they are starting to back off a bit. So I'm a little bit more encouraged on the rental side. And I guess what I would, or the affordability side, I guess what I would say is keep up the good work on the supply side, but we can't expect miracles on that front. Like I said, it's like a glacier that can only move slowly. In terms of the broader policy landscape, how do we respond to tariffs? What would I tell the prime minister or the incoming prime minister, whoever that might be? I would say the initial things I've seen over the last 24 hours, they're talking about like COVID-like response in terms of government spending. Wrong answer.
Mm-hmm.
Wrong answer. I think we have to see this as potentially a hostile U.S. actor on the trade front for years to come. This is not going to be solved by a short-term fix by throwing money at people and businesses to try to get them through this. I think we have to think much more strategically. First of all, and a few premiers are on board with this, we have to knock down some of the interprovincial trade barriers, free up trade within Canada. That's been talked about for decades. This might actually be what lights a fire under politicians and gets them going. And in terms of spending money, yeah, I mean, we have to, look at things that are long term that are actually going to improve this economy. That's like improving infrastructure. So, and infrastructure spending has been coming back in recent years, but that's where I would put the focus. More longer term ways to structurally improve the economy. Relook at the tax system, which is hopelessly inefficient in this country. That's the kind of things I think we should be looking at, not this short-term papering it over with tons of money for workers and businesses. Yeah, we have to, obviously the safety net has to be there for anybody who gets laid off. But no, don't talk about like the kind of COVID supports that, just threaten it's just a short-term sugar high that costs a lot of money and disappears overnight. That's not the way to address this issue, I think.
If anything, Doug, I just want to follow up just quickly there. So if I heard you correctly, then when a politician comes out and says, I'm going to build 4 million homes in a period of time, those are maybe not necessarily something that we as consumers in the economy should take with sort of grains of salt if the supply levels move at a glacial pace. What we should really be looking at is better governance in many ways, more responsible governance, it sounds like.
No, I would agree. I mean, all these targets of home building, I think they're ridiculous, and and the numbers have been fanciful. What have we seen in the last 3 or 4 years since we've seen just this wave of talk about bumping up supply? Well, housing starts have actually been slowly but surely grinding down because the market weakened, and the market dictates how many homes get built, not governments. And sure as night follows day, what we've seen is housing starts have been sort of locked in around 250,000, just around 250,000. And that's so in any single year we have never completed more than 250,000 homes, never. And we've been close to that in the last couple of years, but it's almost like there's a ceiling on it. I'm not saying it's physically impossible to build more homes than that, but the industry here is just not set up for it. And we, and really there has not been that much of a change in housing starts in the last 5 years. Like they've been very, very stable in that neighborhood of about 250,000 or a bit less than that.
Thanks. So, just circling back to tariffs, and, myself, like a lot of people are trying to decipher what that really means from the lending landscape and with rates. And I've been reading that, the tariffs are going to cause rates to go up, but I've also been reading that it's going to cause rates to come down. So could you elaborate a little bit about that? And does one come before the other? And what's the thoughts around that?
And this is a bit of a debate. It's actually a debate around, obviously the Bank of Canada is having that debate internally. Looking at their statement today and a lot of their research, I would say they essentially came out and said that it's a bit of a saw for them in their view. They think, yes, there's going to be a big hit to growth, but at the same time, it could actually, on net, actually push up inflation a bit. But they're assuming that there's pretty much full retaliation from Canada. That's why inflation goes up, because we'll be hitting all the US imports into Canada with like size tariff, and yeah, that's going to hit our consumers. That's a big assumption. I don't think that's going to happen. I think what we've seen out of Ottawa there, and there's a debate in Ottawa whether we do full retaliation or not, but I think where they're gravitating towards is to target the retaliation at certain items and lessen the blow to Canadian consumers. They're going to go after items where people can substitute out. So I'll give you, one classic sort of silly example a little bit. Like basically they go after Kentucky bourbon because people can always drink Scotch or rye instead. That's, either from Europe or from Canada. That'd be easy for Canadians to substitute. Like you don't have to drink Maker's Mark. That's the kind of area that they'd be attacking with tariffs. Other areas where we couldn't substitute out, they probably would not necessarily retaliate in those areas because they want to inflict as little damage as possible on Canadians. And even bigger than that, I think just the hit to growth will dominate here. I even though we're dealing with a weaker Canadian dollar, I think inflation's not going to do much. If we're dealing with like a recession caused by tariffs, we're not going to be worried about inflation. I think even though the Bank of Canada wouldn't respond quickly, the trend would be to lower interest rates than would otherwise be the case if we're in a world of trade war. I think that means net, the Bank of Canada would actually cut more than they otherwise would. So I don't think tariffs or a trade war leads to higher rates. I think if anything, it would tend to lead to somewhat lower rates. I will say it's a slightly different picture in the U.S. because there's a little bit less of a hit on growth, and there could be a bit of upward pressure on their consumers because President Trump just seems willing to, put tariffs on anybody and everybody, and some of that's going to seep through to the U.S. consumer. Does that actually mean higher rates in the U.S.? Not necessarily. It just means the Fed might have to go a little bit slower than they otherwise would. But for a Canadian, I wouldn't worry about higher rates. I don't think that's going to be an issue in a trade war.
Well, that leads perfectly into our next segment, which is a topic that is probably the most asked and discussed by our viewers, as many are homeowners and many are about to renew their mortgage. It's 2025 and we're entering what's been dubbed the mortgage renewal cliff, if you will. And that's, of course, people renewing at a higher rate than when they first got their mortgage or renewed their mortgage 5 years ago when rates were basically next to zero. In our last interview together, which was almost a year ago, we touched on mortgage renewals. And you mentioned that you were actually more concerned about 2024 than 2025 and onwards. And while here we are, and if we use the metric of the arrears rate, we know that is still below pre-pandemic levels. So in that element, it looks like you are absolutely correct. But we also know a lot can change in 1 year. And so as we face 50, 60% of mortgages renewing in the next 2 years, what is your current view on how Canadians are going to handle these renewals going forward?
Yeah, and so one of the lines has been that, what used to be a mortgage cliff is now more like a mortgage speed bump. And I think that's the way to look at it. Like, I wouldn't dismiss it. I mean, obviously, people who locked in for 5 years and 20 and 21 are going to be looking at higher payments. They've known that train has been coming at them for the last couple of years. The reason why I said a year ago that I wasn't that concerned about 25 is I thought interest rates would be coming down. They've actually come down more than what we were expecting a year ago. Like, I believe when I spoke to you a year ago, we were looking for about a percentage point in Bank of Canada cuts last year, and instead we got 1 3/4. And so okay, we're not all the way back to 20 levels. We'll never get back to 20 levels, by the way. And I suspect many people knew that when they took out a mortgage, that's about as good as it was going to get back in 2020. People have had a couple of years to prepare for this. I think it's one of the reasons why the personal savings rate is a lot higher now than it was before the pandemic. Households have been readying for this. The other piece of good news, besides the fact that rates have come down, is the housing market overall is held in there. Worst comes to worst, if people cannot afford their mortgages and they have to sell, they're going to be selling into an okay market. It's not a banner market, it's not a booming market, but it's okay. Like they're not, we're not seeing a lot of forced selling right now. We're certainly not seeing a lot of forced selling. So it's not like prices are under a lot of downward pressure. So even in the worst case scenario that you can't hang on to your place, the market is stable. I would say in most cities. I think that's the case in Vancouver. Vancouver's actually held up well. I would say maybe not as well as say a Calgary or Edmonton, but it's held up well. And so from a macroeconomic standpoint, it's just not that big of a deal. It is a big deal, admittingly, for people who are, that's and it's a relatively small share of the overall Canadian population who's got a 5-year mortgage that's coming due this year or next year. Like we're talking, less than 10% of the population who falls into that basket. The other 90% are all looking at interest rates coming down and, are enjoying this. And that's what drives the economy. It's not that thin slice that it has to actually renew this year. So, and like, I don't think the Bank of Canada is done, by the way. I think rates are coming down further. We didn't get into our official call on interest rates, but I think, if we were to come back a year from now, we're going to find that rates are lower than they are now.
Interesting. When we talk about rates and we talk about supply, we also talk about price. And when we consider general real estate prices in Canada's major markets, the current inventory levels and the huge amount, like we just talked about, of what we discussed, the upcoming renewals. How do you think this will affect prices, or even, if it's such a small percentage, or it is a small percentage, will it really have much of an impact on prices at all? And if it doesn't, then it really wouldn't have too much of an effect on supply and demand either. But I'm just curious to see where you think prices are going to go as a result maybe of interest rates over the course of 2025.
So, of course, the big decline in interest rates sets a much more constructive backdrop for the market. And, we have seen sales get up off of the mat in the last 3 to 4 months or so. It was interesting when the Bank of Canada first began to cut. I think everybody was, waiting for the market to come roaring back. And instead, what happened is listings came roaring back initially. A lot of sellers came out of the woodwork, but buyers didn't. But buyers have started to reemerge in the last 3 to 4 months. And I'm talking nationally here now. In November and December, we had something very unusual happen. Sales were actually pretty close to their long run average. So the Canadian market overall was kind of normal, after about a 2-year slumber. It wasn't ridiculously hot. It wasn't icy cold. It was about normal. And I think that does set the stage for somewhat better prices over the next year. But I will stress there is a massive regional story here. It really does depend on what city you're looking at. Like there are vast divergences here. I mean, if you're talking about the Toronto condo market, it's like the Ice Age. In the latest month, Toronto was the one city of the top 25 cities in the country. It was the one city where average transaction prices were below a year ago, and that was mostly a condo story, not entirely. Every other city had prices higher than they were a year ago. And I was actually just out in Edmonton recently, and I told them, you do realize that it's not fair that Edmonton has both the hottest housing market and the best NHL team in Canada at the same time. That is just not fair. And I'm not necessarily an Oiler fan. It's just fact. It's debatable whether Edmonton has the hottest housing market. Calgary's might be a little bit hotter from most metrics. But they've held up very well throughout this piece, and they probably are still best positioned at this point. Meanwhile, a lot of Ontario still getting up off of the mat. A lot of Ontario prices are down double digits from peak levels still. That includes Toronto. And Vancouver somewhere in between. We've obviously got a really split story between the condo market and the single family market in Vancouver. But I would say, given the kind of wild changes we've had in rates in the last couple of years, the huge immigration shifts in population, Vancouver's market has actually been surprisingly stable overall. It's sort of been in the middle. It hasn't been as strong as Calgary's. It hasn't been as weak as Toronto's. It's actually been kind of normalish, which is unusual for Vancouver. But I would say when we look ahead, I would be mildly constructive on the housing market overall, and that includes Vancouver. I do think the rate backdrop will dominate. I don't see the market firing back on all cylinders. The two big blocks against the market, well, I should add a third. There's a lot of uncertainty around tariffs and the economic landscape, but forgetting tariffs for a moment, I think that the two big blocks are affordability is still really weak across most of the country. And of course, that's especially the case in BC and Ontario. But I think the other issue is the population growth support has been knocked away, at least for a couple of years. It'll come back eventually, but for the next couple of years, it's a reason to believe that the market isn't going to come roaring back in a lot of economies or a lot of cities, because it's just a very different population growth environment that we're looking at versus the past couple of years.
So, Doug, if I can just follow up just with one quick question there, because I think it's interesting. When you consider sort of the median age of families that are buying homes in Canada, I was looking at the National Association of Realtors yesterday out of the US, and I was surprised to find that the vast majority of people buying property in the US are actually in their 50s and above. They seem to be one of the dominant age categories. And I'm wondering, looking at Canadians and their younger population and the people who are getting in, since we just talked about maybe prices stabilizing in some instances, you might find opportunities. What would you say to a young Canadian who's looking to buy their first home right now? Would you get in now, or would you wait a little bit later, and would you see how this plays out?
Hmm. I mean, my advice usually is if you can afford it, um, I don't really see I don't see that as necessarily a great strategy to wait.
Mhm.
There are certain instances, yeah, where I don't think it makes sense to jump into a wild frenzy like we saw in 2021, for instance.
Mhm.
When the market is absolutely out of control, I think it actually might make sense to just stand back, don't get caught up in the FOMO. But I think right now, as I indicated earlier, the market's actually reasonably well balanced. It doesn't seem to be ridiculously hot on the one side or icy cold on the other side. Rates are going to come down somewhat, but that probably will bring in more competition as well
Mhm.
on the buyer side. So
Yeah.
as I indicated, each city's a little bit different at this point. Um, but no, I wouldn't necessarily advise to wait.
So I guess the question that everybody wants to know the answer to is what's Bank of Montreal's official call for the remaining rate decisions for the rest of the year?
So we finally get around to the punchline, and of course, this really does, I think, depend on what happens on the tariff front. But so our base case is for another two rate cuts. We suspect they might get spread out a little bit. So officially, we've got them cutting in the April and the July meeting, and then holding at 2.5. We see 2.5 as being pretty close to neutral. And by the way, the Bank of Canada is very upfront about what they believe neutral is. Their official view right now, and we're talking about the Bank of Canada's overnight interest rate on which everything else is built. Their view on their overnight interest rate is neutral, is between 2.25 and 3.25. I think they're going to bring that down a bit because of the immigration changes. They'll see neutral as being a little bit lower, so they'll go to between 2 to 3%, and middle of that is 2.5. That happens to jibe with what we think is pretty close to quote normal for interest rates. That would be exactly half of where we peaked out. As it happens, we were at 5% when we spoke early last year, and the bank's already brought rates down by 2 percentage points, so we need to see another half point. Our view is if we're in full on trade war, we're going lower than that. We've been talking about possibly down to 1.5% on the Bank of Canada's overnight interest rate. I would point out they've been a lot lower in the past, like during COVID, and we're not going to those kind of lows. But during COVID, of course, they got rates down to a quarter. After the financial crisis, they also got rates temporarily down to a quarter. They took them back up to 1% pretty quickly. But they were around 1% for a long time there. So 1.5 is certainly doable. That would be consistent with, like I said, a full-on trade war. If we're in sort of mini trade war, which is a possibility that Trump puts minor tariffs on Canada and Mexico, and scolds us. I'm gonna let you off with good behavior for now, but you wait, I might raise them more. If it's kind of like say a 5% tariff or something like that, we can definitely handle that. And I suspect that might not affect the Bank of Canada policy overlay, and we might still end up in something like 2.5% or slightly lower in that kind of world.
So if we keep cutting and the states keeps being kind of as strong as it is, And even after today's cut, of course, we saw an immediate impact on the Canadian dollar weakening against the US dollar. And, Tiff has asked that question repeatedly, and he's quite poignant in stating that, look, yes, we understand that's a bit of the expectation of what's going to happen, but it's also not the BOC's mandate. So, kind of tough here. But, the CAD is down almost 9% against the US in the last year. And I guess two-pronged question here, Doug, is first one is predictions on maybe how much further that could potentially weaken. And I'm also curious about how much does import inflation with a weaker Canadian dollar weigh on the total CPI basket?
And I have to say, today was the first time that we saw a flash of concern from the Bank of Canada about the Canadian dollar. For almost since the day that the bank began cutting interest rates last June, Macklem has been very consistent that, yes, we know there are limits and how far the bank can separate from the Fed, but, we're nowhere close to those limits. And he just kept pushing. And I have to say, I was a little bit surprised how he didn't seem at all concerned about the currency, even as it was pretty obvious it was starting to have an effect last fall. Well, now they're concerned. That doesn't completely tie their hands, but he pretty much said it, that it's going to enter into their calculation now in terms of how much lower they bring down rates. And that's why we've only got them trimming rates a little bit further from here on out. We, as I said, unless we're in a full-on trade war. How much lower can I know you asked a lot of questions there. How much lower can the currency go? Well, the all-time low is in the low 60-cent range. That was hit back in 2002. If we're in a trade war with the U.S., I think we might test those kind of levels again. A full-on trade war is really bad news for the Canadian economy. It's going to hurt us a lot more than the U.S., and I think the Canadian dollar is the one that's going to take it on the beak if we're in a trade war. It's a different story if we avoid it. I actually think some of the weakness we've seen in the Canadian dollar is building in that risk of a trade war. I believe the Canadian dollar is undervalued right now. If there are no tariffs, I would look for the Canadian dollar actually to come back a bit. I'm not especially bullish on the Canadian dollar. I would see it rising a little bit above the 70-cent level, though, if we don't get into, if the U.S. doesn't hit us with tariffs. On the import price pass-through, so over time, the currency's become a little less of a driver of Canadian inflation. But, we've seen in the last couple of years, firms are a little bit faster now to pass on their cost increases. And I would be a bit worried about the inflationary impact of a weaker Canadian dollar. One of the grocery store CEOs actually just warned about that in the last 24 hours, said that, look, we import a lot of things from the U.S., especially fruit and vegetables in the winter. And, that we have to pass on some of those costs. That's one of the most direct examples. But even gasoline prices, we essentially, we're driven by global oil prices converted back into Canadian dollars. If the Canadian dollar weakens, even our gasoline prices will see some upward pressure. And of course, we import lots of things from the US and China. I'm not overly worried about the inflationary impact of a lower Canadian dollar, but the direction is clear. It does threaten to push up inflation a bit over the next year.
Doug, you make an interesting point. When you talk about specifically importing inflation, 70% of what we have in our fridge is typically imported. And so would then, instead of these COVID level responses that the government has talked about, knee-jerk reacting to, would it not make then better sense to maybe offset the cost of groceries by, with the Canadian government coming in to help there while taking on, instead of, just blanketly dropping everything, and like you said, getting a sugar high off of this. And then I think there's some opportunity there for Canada to actually work as a country to lower its restrictive trade barriers between provinces so we can actually work better together, get our resources to each coast, as an example, and actually take advantage of a situation that would make us stronger against the U.S. But I gather this isn't a quick response. This is a longer-term response.
Yeah, I think it is. On the grocery price inflation, trust me, I think during, when grocery prices were running wild in 22, I do believe that policymakers across the country were trying to figure out ways, and they even brought in that so-called grocery price rebate, which was really just a check, glorified check. One thing I actually recommended to a finance committee at one point was, just thinking about shifting on groceries. Most of them have a zero GST. How about a temporary negative GST on groceries for a spell, just to offer some relief? And I think that was given a passing thought, and it ended up being the grocery rebate that they brought out later. It's a challenge, though. I mean, if there was a way to really help people out on that front, I think we would have found it by now. There isn't really a great solution, and I think this is why they keep coming back to basically just giving people checks, and maybe below a certain income threshold, and that's what even the federal government proposed again late last year, and somehow that quietly died. That idea, just quietly went away, and amid the hubbub of the finance minister stepping down. But there isn't really a nice, neat, tidy way to offer that relief that isn't prohibitively expensive, unfortunately,
or inflationary.
Mm-hmm.
So for the last year, we've seen the government make some changes to lending policies and rules. CMHC obviously is a big one, going up to 30 years. And then most recently, again, going up to 1.5 million for CMHC mortgages. Do you anticipate or see any future changes to any lending policies?
Well, I wouldn't rule it out, but I think they've probably done what they think they need to do at this point. And given a much milder interest rate backdrop and a housing market that nationally, again, I would stress, is better balanced and seemingly normal, I don't think they feel a lot of pressure at this point to make any changes. In fact, I do believe there was a bit of pushback when they proposed the small tweaks they made last year, from folks like myself who said, all you're doing is spurring demand. You're not doing anything on the supply side. It really doesn't help out longer term when you make those kind of tweaks. I know, some folks in the industry love it when they make those kind of tweaks, but does it really change the affordability calculation? I don't think it does. It just, increases the fellow competitors on the buy side. And the first people to get in, probably it helps their affordability, but it doesn't change the affordability of the market overall when they make those kind of adjustments. So just going back to my initial answer, I think the housing market is in a place that they don't really think that it requires big changes at this point. They've got a lot of other concerns on their plate at this moment.
Oh, just let it be more of a free market. What a novel idea that would be.
Absolutely.
Doug, this has been incredibly insightful. On behalf of all of us and our viewers and listeners, thank you so much for your time today. We look forward to following your career and seeing what happens at the next Bank of Canada announcement on March 12th and how you dissect what happens then. Thank you. And thank you everyone for tuning in this week. We will see you here next Saturday. Have a wonderful weekend.
Thanks for having me.